Okay, video 4. We talked about current marginal tax rates for a single individual here in 2021. Here's 1981 before Ronald Reagan. You can see there were a ton of brackets, 14, 16, 18, 19, 20, 21%. I mean, every few $100s. And it started at 2,300 and it maxed out at 108,300 at 70%. So 70% of everything that we made over 108,000, again, as a single individual income, salary, was taxed at 70%, and that was way too much. It was astronomical. I 100% agree with having cut that. Again, I said a bunch of the benefit is up in these smaller numbers. So from 1981 to 2021, the inflation rate consumer CPI would have been a multiplier of about 3.6. So you can multiply any of these numbers by 3.6 to put it into today's dollars, which means that if we had these same tax brackets right now, a single person making $388,000, everything over 388, okay, not before, but everything over 388,000 will be taxed at 70%. And again, I absolutely think that's high. I'm not arguing that at all. And here's what happened under Reagan. Suddenly we went to two tax brackets. By the end of his term, we had two tax brackets, 15% and 28%. 15% was happening around $18,500, so $65,000, $70,000, which again, kind of that middle upper class for a single person, depending on where you live. And 28% on everything over that. Well, again, consider how much money is out there that is over right now, $65,000 or over $18,500. It is an astronomical amount of money. And it all used to get taxed at 39 to 70%. And by the end of Reagan's term, it dropped to 28%. So here's what happened. In 1982 and 83, tax revenue dipped. It did not go up. GDP still grew, but tax revenue dipped. And by 1984, so it took 3 years, we were finally having a situation where the government was collecting as much money or slightly more than it had been before. But the number, the percentage overall dropped from 12.3% to 10.1%. And over those 3 years cost us about $190 billion in tax revenue, which is part of what started the deficit that we have today.